In this week's market update, trade tensions deepen as Trump launches new tariffs. Turkey calms emerging market fears with a big rate hike. Oil is back above $80 a barrel, and lessons from Lehman 10 years after the crisis. The relationship between China and the US plumbed new depths this week as Donald Trump delivered on his threat to impose tariffs on another $200 billion of Chinese exports to America. The new levy extends the items hit by tariffs to a wide range of consumer goods and begins next Monday at a 10% level. The intention is that this will concentrate the minds of China's trade negotiators and lead to a deal that, in America's eyes, levels the playing field on global trade. If it doesn't, the president says that the tariff rate will rise to 25% in the new year. The Chinese had called on further negotiations ahead of America's midterm elections, so it will be interesting to see whether the White House's new aggressive stance changes that position. From a Chinese perspective, the trade situation is becoming much more dangerous as the public mood at home deteriorates alongside a slowing economy and against a backdrop of tighter political controls. The Shanghai stock market closed today at its lowest level since 2014 on trade fears and on the worsening economic picture. Chinese shares have now fallen by more than 25% from their peak in January, well in excess of the usual measure of a bear market. This has happened even as US markets have continued to hit new all-time highs. To make matters worse, the Trump White House seems to be enjoying its apparent upper hand in the ongoing trade war. As the president said on Twitter, tariffs have put the US in a very strong bargaining position, with billions of dollars and jobs flowing into our country. He went on to say, if countries will not make fair deals with us, they will be tariffed. The trouble from a global trade perspective is that he's probably right. The implementation of tax reforms earlier this year has given the US economy a boost and increased America's leverage with its trade partners. China, for example, is unable to simply retaliate with America with its own tariffs because it exports so much more to the US than it imports from it. America has a lot more firepower and China knows it. Indeed, if the president doesn't get his way, then it seems likely that America could yet extend tariffs to all $500 billion of Chinese exports to the US. The importance of trade tensions for investors this year has been underscored by the disappointing performance of equity markets in those parts of the world most exposed to global trade. Japan has underperformed despite reasonably strong growth and rising corporate profits. Europe has been weak too. Even before they were confirmed on Monday night, the latest tariff threats had hit mining shares and metal prices. Shares in commodity producers have fallen by more than 15% since June, as investors have worried about slowing demand for metals. China is the world's largest consumer of almost all commodities, and it's been estimated that the tariffs on $200 billion of exports could knock GDP growth by a full percentage point. The other big market story at the moment, the threat of an escalating emerging market crisis, has actually eased somewhat as investors start to take a more nuanced view of the investment class and stop tarring all developing countries with the same brush. For example, it's becoming clearer that the emerging markets in Asia are much less exposed to the strengthening dollar than in other parts of the world, such as Latin America. A rising dollar is bad news for two reasons, one of which applies to all emerging market countries and one which is more selective. The general risk aversion to all emerging markets is caused by the increased competitiveness of US assets as the dollar and US yields rise. For American investors, it's possible to generate a more than adequate return by staying at home with much less risk. The more selective risk, however, relates to those countries with a dependence on dollar-denominated debt, weak current balance sheets, or a lack of foreign reserves. Here, Asia seems in much better shape than the rest of the developing world. Turkey and Argentina have been the high-profile examples of these risks, and last week Turkey responded to the collapse of its currency with a much larger than expected increase in its interest rate to 24%. Argentina, of course, had already imposed the world's highest rates at 60%. There's been a significant change in emerging markets since the last big financial crisis in the late 1990s. At that time, most countries in Asia had current account deficits, US dollar pegs and fewer currency reserves. Now the picture looks very different. To take South Korea as an example, it had foreign exchange reserves worth 5% of GDP in 1996, but 25% last year. China's reserves have also doubled to 26%. South America, by contrast, is in a much more vulnerable state, with inflation a problem in some countries like Venezuela and higher political risk, with populist governments stepping back from making the economic decisions their countries need. The key question is whether the bad news is now in the price for emerging markets. Selectivity is key. Even more than usual, generalising about emerging markets makes no sense today. Now, oil is back in focus again as the price of Brent crude briefly rose above $80 again and within a few cents of a multi-year high. The fundamentals are pointing towards higher prices, with the International Energy Agency warning of a supply crunch as the US imposes sanctions on Iran from November. In the face of this big hit to global supply, the biggest surprise may be that oil has not risen further than it has. The cost of crude has struggled to rise beyond its well-established recent trading range between $70 and $80. There are a few reasons for this. First, $80 is the level at which Donald Trump twisted the arm of the world's main oil producer, Saudi Arabia, to pump more oil and put a lid on the oil price. Ahead of the midterm elections, the president is likely to want to keep oil affordable for US consumers. $80 a barrel oil is also roughly the level where economists worry that energy costs will start to eat into demand. That's especially true in emerging markets where weak currencies have increased the local cost of a commodity which is priced in dollars. Finally, trade war fears have provided further downward pressure on oil. Slowing global activity is hard to square with a rising oil price. Now, it would be remiss to let this week pass without a nod to the 10-year anniversary at the weekend of the collapse of Lehman Brothers. The high water mark of the financial crisis was perhaps unsurprisingly close to the low water mark of global stock markets, and investors have enjoyed a good decade, albeit one with plenty of market volatility along the way. The main lesson from the past 10 years for me has been the crucial importance of diversification in an investment portfolio. Our analysis of the performance of the main asset classes since 2008 shows that in no single year has the best performer been the same as in the previous year. It also shows that in no single year have all the main assets fallen in value. Usually there have been winners and losers, and a well-diversified balanced portfolio has therefore enjoyed a much smoother ride than one trying to pick the winners and avoid the losers. Looking forward to the rest of this week, it's relatively quiet on the corporate front. Kingfisher's results tomorrow are a highlight in the struggling retail sector, and there's also a trading update from Ocado, the online grocery delivery service. On the economic front, attention will focus on inflation data in the UK on Wednesday and retail sales on Thursday. Investors will be looking for any pointers to the Bank of England's next move. Last week's subdued wage growth data, barely above rising prices, suggests that the bank will remain cautious against a backdrop of Brexit uncertainty. And on that front, the International Monetary Fund weighed into the increasingly polarised debate by warning that the UK economy would suffer what it called substantial costs if the UK left the EU without a deal. In its annual assessment of the British economy, the IMF said that Britain would struggle to exceed a 1.5% growth rate in the years ahead.